Corporate finance practice problem using OneNote. Rights offering introduction problem. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the practice problems, then down in the 1721 rights offering introduction problem. Also note, when using OneNote, look at the immersive reader tool. Our problems up top will be in the text area as well. Same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top. We're going to go through the calculations on down below. We're a rights offering type of situation. Now, the typical scenario for a rights offering situation is a corporation that needs cash, would like to have capital, and would like to generate that capital through the issuance of the stocks. However, the stocks have already been issued. There's already been an issuance, so this is not the initial offering, and therefore the existing stockholders may be somewhat skeptical with the issuance of stocks because they could fear that it dilutes the value of the stocks that they own as well as their ownership percentage. The corporation could then give a rights offering to the existing stockholders as a way for them to be able to purchase the new issuance of stocks at a discounted price in order to basically maintain their level or percentage level of ownership in the corporation and possibly maintain the same kind of value of the stocks that are going to be issued. So when we think about this type of scenario, you have this window of when the rights offering is going to be taking place, right? They're going to have the rights offering, and then at some point in time, it's going to close up, and you've got this time in between. And the question is, well, what's going to happen during this time? Where do we stand before this rights offering took place, and where do we stand at the end of this entire process? Now, note, when the rights offering takes place, we start off with a current price before the rights offering took place. And once you say that there's going to be rights that are going to be offered, then you get this situation where you could basically value the portion of the market value that's with regard to the rights and the portion of the value of the stock that's going to be with regards to the stock itself, because you basically have these two things. At some point in time, you could then sell those two things separately, possibly detach them and then sell them. And then at the end of this whole process, where are we going to stand at the end of this? Well, more shares are going to be issued by the corporation. The corporation is going to be picking up money, but the money that the corporation is going to be picking up is not going to be equivalent to the current market value before they issued the rights. And therefore, you would think that the price per share of stock would go down slightly due to that difference, due to that discrepancy. We'll talk a little bit more about that as we go. And of course, there's going to be more shares on the market, so you can determine what's going to happen to the earnings per share and the price earnings ratio and that kind of stuff, which we'll do in future problems as well. So let's think about this situation. We have the rights offering. We got the current stock price, which we can think about before the rights offering basically took place. We got the exercise or subscription price. That's going to be the price that you can then purchase the new share for. So the existing stockholders, in other words, we're going to imagine that they're going to get rights that are going to be provided to them as the existing stockholder. They're going to have to cash in those rights along with the subscription price or exercise price, the discounted price, which in this case is the $30. Notice it's below the $40 market price before this took place. And they're going to need the rights of 4 rights in order to do that. Now, typically, we're going to basically, in most of the scenarios we think about, we're going to be thinking that for every share, the corporation offers 1 right per share. So it's going to take 4 rights for them to then accumulate 4 rights before they can take advantage of the exercise or subscription price in order to buy 1 new share of stock. So that's where we stand. So now we can think about, okay, well, what's the rights value during the cum rights period, and what's going to be the rights value during the exercise or rights period? And this is kind of thinking about the flow as we go through this process of the issuance of the rights and until the exercising and closing of the rights offering. So we have 2 formulas here. The rights value during the cum rights period is going to be the stock price minus the rights subscription price per share divided by the number of rights required to buy 1 share plus 1. And then the rights value during the exercise of the rights period is going to be equal to the stock price minus the rights subscription price divided by the percent or the number of rights needed to buy 1 share. So we're going to start with this top valuation here. So it's going to be the first one typically as our process during the cum rights period. So the stock price minus the rights subscription price per share divided by the number of rights required to buy one share plus one. So we got that plus one as the kind of differential factor here. So we have the theoretical value during time rights offering is announced until 3 days before the subscription right expire. That's going to be the cum rights period with our first formula. So the calculation then is going to be the stock selling price. So we're going to say $40. That's basically the price before this thing took place. And then before the rights offering, then the subscription price, that's the price at which you can buy the discounted price. If you have 4 rights along with that, then, and the $30, the 40 minus the 30, that's going to give us our 10. That's our numerator. And then we'll take a look at the denominator. We got the rights we need for one new share, meaning we need 4 rights along with the $30 for one new share. And we would get basically 1 right per share if we had the shares before the rights offering took place. So then we're going to add 1 as this first formula demonstrates. The second formula differs basically by that 1 right there. And then we're going to say that's going to be $5. So if we take the 10 divided by 5, the numerator divided by the denominator, we say that the value of 1 right, we're going to say is $2. So at this point in time, we're basically saying the selling price, and you might say for rights on stock at this point in time, would be 40. And then you can think about, okay, well, what then do we believe the value of the right itself is? And that could be useful for us to think about now these 2 components of the stock with the rights on. And we can then say, well, we think that the stock itself is going to be, or the right itself is going to be worth $2. And that means that basically the stock portion we would expect to be worth $38. So we can get to this, a similar type of calculation if we think about the aggregate, the total, by looking at the theoretical X rights price, sometimes called the TERP. So this is one way to kind of think about this in aggregate, what's going to happen in aggregate. If we say that the market price per share is $40 before this whole thing takes place, and then the shares outstanding are 1,000. We're just going to imagine 1,000 shares are outstanding for our practice problem purposes. So 1,000 times 40, that would mean that the value of basically the corporation according to the stock market at this point in time is 40,000, because we're saying there's 1,000 shares out there. They're selling for $40 on the market. So 40 times 1,000 seems that the value is going to be 40,000. You can kind of think about that from an accounting standpoint as the accounting equation, right? Assets equal liabilities plus equity, or assets minus liabilities equals equity. So the market's kind of saying the 40,000 is what they believe on a market value is kind of the value of assets minus liabilities, or the equity value of the company. That's what the market's basically kind of saying. So then what's going to happen? Well, we're going to issue new shares. We're going to issue new shares at a price of 30, and we're going to assume that we have 250 shares that are going to be issued. Now that would be if basically all the rights were basically exercised at the discounted price, because that would mean that we had 1,000 shares, right? 1,000 shares, and we're going to imagine each existing shareholder at that time got 1 right. And if in some way, shape, or form, all of them exercise the right, we would have that 1,000 divided by 4. That would mean we can have 250 new shares that are going to be issued onto the market. So there were 1,000 shares. Now there's going to be 250 more shares. You can see how what happens there. If there's more shares on the market, then you can think about, okay, what's that going to happen to a percentage ownership and that kind of stuff, the portion of the stock that you own. But we can then multiply that out. The 250 times the $30 is 7,500. So that means the company itself, because the company is the one that issued the stock, is going to get another 7,500. So if you think about the accounting equation, and you think about this from an accounting equation standpoint, we're going to say, all right, assets are going to go up by 7,500, and then equity, you would think, would basically go up because it kind of came from the owners, the investment through the issuance or purchasing of the stock. However, that 7,500 was $30 per share, and that's less than the $40 which they were selling at before. So you would think that would result, after this is all said and done, with a price that is going to be less on a per share basis. So in other words, the total value now we're going to say is the 40,000 before, plus we got another 7,500 you can think about in cash Therefore, the value, you could think of kind of the equity value, assets minus liabilities on a market value basis would be 47,500. And then the number of shares now is now 1,000 plus 250. So what's going to be the value per share? It's going to be 47,500 divided by the 1,250, or the $38 per share. Before it was 40 because it was worth the 40,000. Now it went down to 38. That's what we would expect, given the fact that we're assuming that these 250 shares are going to be issued at $30, which is a value less than the market value. That's going to result in the theoretical, value of the stock after this is all said and done to be less, to be the $38 in this case instead of the $40. So obviously you can think about all the kind of impacts that this would have on the existing stockholder if they were to exercise their shares and purchase the new share of stock, or if they were to try to sell the rights if they could at some point in time. And we'll go through multiple practice problems and kind of visit some of those points a little bit more in the future. So then we're going to say the rights offering, the current stock price is the 40, the exercise price, as we saw, was 30, the rights required to purchase is 4, as we saw, and then we're saying that during the exercise of the rights period, the period of time about 3 days before the expiration, during this period, rights may be traded independently of the stock. Stock price during the X rights period, we're going to say, is that 38 instead of the 40, and now we're at a period of time where basically you can actually detach the rights and the stock itself and possibly be trading the rights, the value of the rights, and then the stocks. That means that the stock is now at a lower value. We're going to say it's that 38 value here. So the exercise or subscription price is still 30, but now the stock price X rights, as opposed to the stock rights before, which you can think of before, or rights on, was 40. We're going to say now it's 38, and we still have the required to purchase a share at 4. So during this time, the right value for the come rights period, you'll recall, was this equation up top, which had the plus 1. Now we're at this period, the rights value during the exercise of rights period, which is the formula of the stock price minus the right subscription price over the number of rights needed to buy one share. We don't have the plus 1 now. So now we're going to calculate that. We're going to say the stock price during the X rights period is now 38 instead of 40. And we're going to then subtract out the exercise or subscription price, the discounted price that it could be purchased at. If you also give the 4 rights along with it, that's going to give us the 8, the numerator, which is going to be 8. And now the denominator is simply going to be 4, the number of rights that are needed. We're not going to be adding 1 to it. 8 divided by 4 is going to be 2. So there's our 2. Now, so at this point, we can think, okay, if you're an existing stockholder, possibly you can acquire more stocks if you have the rights to do so, plus at the $30. Or if you're given the rights, possibly you can sell the rights, or you can have the nil paid price. So let's go on down below. If an investor chooses to sell his or her right outright in the market, or if they choose to let the right lapse, which may result in a minimal administration charge, they will receive the theoretical nil paid price of the right. So this value is calculated by determining the difference between the subscription price the investor paid and the theoretical X rights price. So depending on how the right is going to be set up, if you can trade the rights offering, then you can trade it and basically get paid for the right itself on market, or depending how the rights are set up, if you just let it lapse, then you might get paid, say, the nil paid price, which could result in some administrative fees as well. So that could be calculated, the current stock price at the 40 minus the stock price during the X rights period, which we calculated to be 38, which is the nil paid price, the $2.